What if everything we thought about economic strength was upside down? For a long time, the US dollar stood tall. It was a symbol of confidence, of power. It surged when markets believed in the promise of lower taxes, bold trade moves, and a booming economy under President Trump. Headlines called it a comeback. Investors poured in. Even ordinary Americans felt it. Groceries were a little cheaper, vacations abroad didn't sting as much, and markets were hopeful. But what if that strength was built on shaky ground? In the last few months, something shifted, quietly at first. A little dip here, a market correction there. But now the signs are too loud to ignore. The dollar is falling fast. And it's not just numbers on a screen. It's deeper than that. We're watching something bigger unfold. A clash between policy and reality, between power and unpredictability. Because here's the twist. The very policies that once lifted the dollar, tariffs, tough talk, tax cuts, may now be dragging it down. Not because the ideas were flawed in theory, but because of how they were applied in practice. Erratically, inconsistently, often without warning. And with every unexpected tariff or tweet, investors are getting nervous, really nervous. You might be thinking, okay, but why should I care? Well, when the dollar drops, your world gets more expensive. From smartphones to fuel, from groceries to rent, it all starts to climb. And in the background, borrowing costs for the government rise too, pulling the economy closer to a very familiar cliff edge. And here's where it gets even more complex. The Federal Reserve, our central bank, now stands between two forces, rising inflation on one side and a former president who might want lower interest rates on the other. So is the dollar's decline just a temporary slump? Or are we looking at the early signs of a larger economic reckoning? In today's video, we'll go deeper. We'll trace the story from optimism to uncertainty, from headlines to households. And by the end, you'll understand not just what's happening, but what it means for you. Let's begin. Ever wonder why the dollar felt so powerful not that long ago? Like no matter what was happening in the world, the US always seemed to hold the upper hand. That wasn't by accident. There was a moment between late 2023 and early 2024 when optimism around Trump's potential re-election lit a fire under the dollar. Investors were excited. They saw the return of bold policies, tax cuts, deregulation, tough on China trade tactics. To many on Wall Street, it felt like deja vu, but in a good way. The dollar index, which measures the strength of the dollar against a basket of other major currencies, climbed steadily from September and peaked in January, almost a 3-year high. It was a strong run, but here's what's interesting. This surge wasn't just about faith in America. It was about faith in certain kinds of policies, ones that businesses expected to make them more profitable. For example, tech companies anticipated lighter regulations. Finance firms looked forward to higher interest rates, which would boost returns on savings and U.S. bonds. And import-heavy retailers saw strength in a strong dollar. It made foreign goods cheaper to bring in. Think about it. If you're a company like Apple or Walmart, a strong dollar means lower costs on components, manufacturing, and inventory. It means margin. It means stock prices go up. And for regular folks, that translated to something real. Cheaper TVs, stable gas prices, a dollar that stretched further, especially if you were traveling, investing overseas, or buying imported products. But, and this is where it gets tricky, those gains were largely rooted in expectations, not long-term certainty. That's the part we don't talk about enough. Markets move on hope as much as data, and hope, when paired with unpredictability, becomes fragile. Personally, I remember looking at the markets back in December, watching the dollar rise and thinking, this feels too good to be stable. Because behind the strength, there were cracks, rumors of erratic tariffs, global tensions, a sense that policies could shift overnight. And when confidence is built on sand, it doesn't take much to wash it away. So yes, the dollar was strong, but it was also walking a tightrope, propped up by anticipation, not structure. And as we'll see next, it didn't take long for that rope to start fraying. Let's look at what happened when that confidence began to fade and how one tariff announcement changed everything. Here's something that might surprise you. While the dollar was climbing and investors were cheering, President Trump was, ironically, not thrilled about it. Why, everybody? Because a strong dollar, while great for consumers and Wall Street, can actually make it harder to achieve one of Trump's biggest economic goals, boosting American manufacturing and exports. That's the contradiction at the heart of this whole story. Trump campaigned and governed on the promise of bringing factories back, rebuilding industrial towns, and rebalancing trade in America's favor. He wanted made in the USA to mean something again. But in reality, a stronger dollar makes U.S. goods more expensive overseas. That hurts exporters. It puts pressure on American manufacturers trying to compete globally, especially with countries like China, Mexico, and Germany, where labor and production costs are often lower and their currencies are weaker. Let me give you an example. Say you're a company in Ohio that makes precision tools. You're trying to sell to clients in Europe. If the euro is weak and the dollar is strong, your tools just got more expensive without you changing a thing. And that can cost you the deal. Now here's where it gets even more interesting. This isn't the first time a U.S. president has run into this exact problem. Back in the early 1970s, Richard Nixon faced something similar. The dollar was too strong and American exports were suffering. So what did he do? He took the U.S. off the gold standard and devalued the dollar. It was a dramatic move, controversial for sure, but it worked. Exports surged, domestic production got a boost, and the global economy shifted. Now, I'm not saying Trump should or even could do something as extreme, but it's worth pointing out that the tension between a strong dollar and a pro-manufacturing agenda isn't new. And here's my take. Trump's economic strategy has always been about strength, projecting power, cutting deals, asserting control. But currencies don't follow political narratives. They follow trust. And when your policies send mixed signals, the markets pick up on that confusion fast. That's what started happening here. Trump's tough talk on trade clashed with market optimism. Investors saw tax cuts and deregulation. Trump saw a currency he wished was weaker. Two visions, pulling in opposite directions. And that disconnect planted the seeds of uncertainty, which brings us to the turning point. When that optimism began to crack and the dollar's climb turned into a slide. And right at the center of it all, the tariffs. Let's take a closer look. Have you ever had a moment where everything looked fine until one sudden decision changed everything? That's exactly what happened with the dollar. Its slow and steady slip turned into a slide the moment Trump's Liberation Day tariffs were announced. Now, if you're not familiar with the term Liberation Day, you're not alone. It wasn't some long-planned economic rollout. It was a moment, a sudden unveiling of massive tariffs on Chinese goods, dropped almost theatrically with what the media called Trump's chart of doom. The headline? A whopping 145% tariff on a wide range of imports from China. To put it bluntly, this was more than just another trade maneuver. It was a shockwave. And what really threw people off was how unpredictable it all felt. There was no clear strategy, no coordinated messaging. One day we were talking about getting tough on China, and the next, a complete rollback of some tariffs, just hours before they were supposed to take effect. I remember watching the markets that day. They didn't just react, they recoiled. Investors hate uncertainty more than bad news. And this was chaos. Let's look at one specific example that really captures the dysfunction. Smartphones. So under the Liberation Day tariffs, Trump announced an exemption for Chinese-made smartphones. Sounds good for American consumers, right? Sure, if you're buying a new phone, you might have saved a few $100s. But now imagine you're an American company trying to build smartphones. You don't get an exemption. You're paying that 145% tariff on components like batteries, screens, semiconductors, most of which are still made in China. So now, not only are you competing against imported phones that dodge the tariff, but you're also stuck with massive input costs. That's not just bad policy, It's punishing the very businesses we claim to support. And this pattern showed up everywhere. Automakers facing price hikes on Chinese-made parts. Grocers watching costs rise on imported packaging or processing equipment. Even basic consumer electronics, earbuds, chargers, kitchen appliances became more expensive overnight. The irony here, the tariffs were meant to protect American industry, but in many cases they made it harder for American producers to compete, both at home and abroad. From where I sit, this wasn't just an economic misstep. It was a communication failure. It left business leaders guessing. It left markets rattled, and it sent one loud message. No one really knew what was coming next. That fear, that instability, is what started pushing the dollar down. But the story doesn't end there, because the tariffs didn't just shake the currency. They had a domino effect, one that reached all the way to Washington, D.C., and the heart of how the U.S. borrows money. Let's talk about what happened in the bond market and why that matters more than most people think. Have you ever watched a small crack in a windshield suddenly spider out across the whole thing? That's what the markets looked like after the tariffs hit. What began as uncertainty around trade quickly rippled into something deeper, something that shook the very foundation of how America borrows money. Let's talk about U.S. Treasury bonds. Now, for most people, bonds aren't exactly the most thrilling dinner table topic, but they're a critical pillar of the American economy. When you hear that the government is borrowing, this is where it happens, by issuing Treasury bonds to investors around the world. It's how we fund everything from infrastructure to defense to Social Security. So what happens when those investors start to get nervous? They demand a higher return. That's exactly what we saw last week. The 10-year Treasury yield jumped from 4% to 4.5% in just a matter of days. And for context, that kind of move is massive in the world of government debt. It's like watching mortgage rates jump half a point overnight. Why did this happen? Well, when the dollar starts to fall and the government is signaling chaos through unpredictable tariffs, debt-heavy budgets, and market stress, investors pull back. They worry the U.S. won't be as safe a bet as it once was, so they demand more for their money. It's a feedback loop. Higher yields mean it's more expensive for the government to borrow. That leads to even more debt worries. And the more worried investors become, the more pressure they put on those yields. It's a cycle that feels eerily familiar. Some of you might remember what happened in the UK not long ago, when former Prime Minister Liz Truss rolled out a sweeping budget full of tax cuts without a clear plan to pay for them. The bond market freaked out, the British pound collapsed, mortgage rates spiked, and the Bank of England had to step in to stabilize the situation. That was the UK, but it feels uncomfortably close to what we're watching now in the US. The Congressional Budget Office recently warned that the new budget proposal could add nearly $6 trillion borrowing over the next decade. Pair that with a weakening dollar and volatile leadership, and suddenly America starts to look just a bit more fragile in the eyes of global investors. And here's the part that sticks with me. This isn't just theory. If you've got a mortgage, a student loan, a business line of credit, this affects you. Higher yields today mean higher interest rates tomorrow. It's real, and it's happening fast. But the biggest concern isn't even the borrowing itself. It's what happens when inflation starts creeping back in, and political pressure meets monetary policy. Let's talk about the role of the Fed and what might happen if Trump tries to put his thumb on the scale. What happens when politics meets interest rates? It's a question we don't ask often enough, but we should, because history has shown us that when presidents try to influence the Federal Reserve, the consequences can ripple far beyond Wall Street. And right now, with inflation risks reemerging and borrowing costs on the rise, the stage is being set for a potential showdown. Let's back up for a second. The Federal Reserve, our central bank, is supposed to be independent. Its job is to balance inflation and employment without giving in to political pressure. And over the years, that independence has helped the U.S. build one of the most trusted financial systems in the world. But what happens if that trust is broken? There's growing concern among economists and investors that if Trump returns to the White House, he may try to pressure the Fed into cutting interest rates, even if inflation is still high. And this wouldn't be the first time a president tried to strong-arm the Fed. Back in the 1960s, President Lyndon B. Johnson physically cornered Fed Chair William McChesney Martin at his Texas ranch, demanding lower rates to support his economic agenda. And in the early 70s, President Nixon leaned on his Fed Chair, Arthur Burns, to keep rates low in the lead-up to the 1972 election. The result? Inflation surged. And by the late 70s, it took Paul Volcker and double-digit interest rates to clean up the mess. So when people say history could repeat itself, it's not just a metaphor. Now, to be fair, Trump has long voiced frustration with the Fed. During his presidency, he publicly criticized rate hikes and even floated the idea of replacing Fed leadership. And if inflation starts creeping up again, thanks to a weaker dollar and rising import prices, there's a real risk that political pressure could override sound monetary policy. Here's the problem. If the Fed caves and cuts rates prematurely, inflation could spiral. If the Fed resists and Trump attacks them publicly, markets could panic. Either way, credibility takes a hit, and credibility is everything when it comes to money. Personally, I think this is the hidden threat most people overlook. We often focus on headlines, tariffs, debt ceilings, gas prices. But the quiet erosion of institutional trust, that's the part that keeps me up at night. Because if the world starts to believe the U.S. can no longer separate politics from economics, the damage could last far longer than any election cycle. And that brings us to the big question. Can the dollar bounce back? Or are we entering a new era, one where uncertainty, not strength, defines America's currency? Let's look ahead and see what could turn this ship around or send it drifting further. What if the dollar isn't broken, but just bruised? That's the question many economists are quietly debating right now. And it's an important one because what happens next with the dollar will impact everything from your grocery bill to your retirement account. So, can the dollar recover? The short answer is yes. But it depends on what happens in the next few months. And most of that comes down to one word: confidence. Let's start with the Fed. If inflation shows signs of picking up again, the Federal Reserve may have no choice but to raise interest rates. That would make the dollar more attractive to investors, especially those looking for safe, high-yielding assets. Higher rates mean holding U.S. dollars earns you more, so money flows back in, strengthening the currency. But there's a trade-off. Rate hikes can slow the economy. They make mortgages, car loans, and credit cards more expensive. And after the roller coaster of the past few years, that's not an easy call to make. Another tool the Fed might use is forward guidance, essentially clearly signaling to the markets what they plan to do next. That can help restore a sense of stability, which might calm the bond markets and reassure global investors. Because again, the dollar isn't just judged on economic numbers, it's judged on predictability, transparency, and trust. Outside the US, other currencies are gaining strength. The euro is up, the Japanese yen is climbing, and China, despite its own economic issues, is pushing for the yuan to play a bigger role in global trade. That means the dollar has competition. Now, it's still the world's reserve currency, and that gives it a huge advantage. But if global investors start diversifying more aggressively, it puts downward pressure on the dollar over time. So what should you, as a consumer or investor, actually pay attention to? Here are a few things I'm personally watching. Import prices. If you notice electronics, furniture, or clothing getting more expensive, that's a red flag. The dollar's weakening is hitting home. Mortgage rates. If those start creeping up again, it could signal bond market stress and inflation fears. The Fed's tone, listen to how they talk. Are they calm and confident, or are they reacting to politics? From my perspective, we're at a fork in the road. With smart, steady action from the Fed and fewer political curveballs, the dollar could stabilize, maybe even strengthen again. But if confusion continues to dominate and economic decisions keep coming from the gut instead of the data, then we could be in for a much longer period of uncertainty. And here's the truth. The dollar isn't just a currency. It's a reflection of how the world sees America. So what story do we want it to tell? In our final section, let's pull all these threads together and talk about what all this really means for you. Let's be clear, this isn't just a dip in the charts. The dollar's rise was fueled by hype. Then came policy contradictions, tariff chaos, and a market stumbling under its own weight. And now we're staring down the barrel of inflation and political interference in the Fed. This isn't theoretical. This hits your wallet, your mortgage, your job security. And if you think the storm has passed, think again. The real question is, are we ready for a Fed under pressure in 225? Or are we walking blind into another economic trap? Smash that, like if this woke you up. Comment below, will the dollar survive this turbulence? Or are we already too far gone? And hit subscribe. Next episode, we expose the blueprint of Trump's 2025 economic agenda. You need to hear this.